morning, everyone. Very warm welcome to today's Regional Economic Outlooks webinar organized by AustCham Korea. As Rowan mentioned, my name is David Lee and I'm your host and moderator for today's session. I serve on the board of AustCham Korea and am a partner at HWLE Ebsworth Lawyers in Australia, where I work closely on matters related to Australia-Korea commercial relations. Look, before we begin, I'd like to thank our fellow Australian Chambers of Commerce in the region, AustCham China, AustCham Hong Kong, and AustCham in Japan, for partnering with us to make this event possible. To all of you who've taken the time to log in from and attend across the region and beyond, thank you very much for joining us. I also want to extend our sincere appreciation to our two partner organizations for this webinar. ANZ Bank, a long-standing gold tier member of AustCham Korea, and Australian Strategic Materials, or ASM, a silver tier chamber member, whose insights today will be particularly timely given recent global developments in critical minerals. Thank you very much to both companies for your ongoing support of the chamber in today's session. Today's session focuses on the regional economic outlook, what it means for business. Understanding the outlook for a region is more critical than ever. We are absolutely delighted to present three knowledgeable speakers today, who each bring a unique perspective to this session. Our first speaker will be Richard Yetsenga, who is the Chief Economist at ANZ. Richard is currently based in Australia, but has spent time in Hong Kong, and is a sought-out speaker and contributor to publications such as the Financial Times and the Australian. He'll be followed by Cameron Mitchell, who is the head of geopolitical risk at ANZ. Cameron also spent time in Hong Kong and London previously, and is an author of articles in regard to geopolitics, including writing a book about the Russian defense industry. Finally, the third and last speaker will be Rowena Smith, the CEO of Australian Strategic Materials. Rowena was appointed CEO of ASM in July 2022 and has over 30 years experience in the mining and minerals sector, including time with South32, BHP and Rio Tinto. Without much further ado, to kick us off, it's my pleasure to invite Richard Yetsenga, Chief Economist at ANZ, to share his outlook on the region's economic trajectory. Over to you, Richard.
Great, thank you, David. Please excuse me, everybody, if I sound a little bit croaky. I'm just getting over a cold. It has gotten a bit rougher for us economists, I have to say. Even President Trump overnight had some things to say about one of my competitor banks' economists and their view that how tariffs would feed through to the US economy. So it's not just me, but the global economy obviously feels quite, unsettled, I suppose. And there are things happening that are unusual, certainly unconventional. And I think maybe I'll continue with the theme, make us feel a bit uncomfortable. And I guess I want to separate a couple of things. All of those things are true. That doesn't mean the world's major problem is a demand problem. A demand problem is a recession problem. In general, I don't think that's the challenge that faces the world. I think most of the challenges are supply side. That's what I mean by shaken, not at shambles. Certainly for export-dependent economies, there are going to be some more meaningful adjustments over time, perhaps than economies that have more domestic demand, but in kind of aggregate on average, I don't think the world has a demand problem. Let me talk about why. Exhibit 1 is the strength of private sector balance sheets, and there are two charts here which have different measures. The left-hand chart is just household wealth for the bottom half of the wealth distribution in the US. Household net worth for that cohort has doubled since 2019, 2018. That's not an uncommon story. I mean, the distribution might be a bit different, but Japanese household net worth is the highest since the bubble burst in 1990. For Australian households, liquid household assets, so excluding the great real estate market here, and excluding pension funds, excluding superannuation, liquid household assets are greater than total household liabilities by the largest margin ever. You can see it in Korea, in New Zealand households. It's quite a common global story, at least outside China, that private sector balance sheets are in good shape. And the right-hand chart is some data published by the BIS on global US dollar credit. The message from this chart is, if you compare the recent 5 years, say, with the 5 years around the global financial crisis, just a much more sober credit environment. In fact, US dollar credit has hardly grown really in the last 5 years or so. And I think you can see both of those things in operation, because our forecast for the global economy this year is 3%. Last year was 3.2, the year before was 3.4, and then 3.6 back in 2022. There's nothing magic about 3, but it is a lot different from 1. And I mention 1 because kind of the standard measure of global recession is global growth below population growth, and global population is growing at about 1% a year. So we've managed to do 3 in the last 3 or 4 years with this year's tariffs and kind of unconventional policy out of the US, obviously a war between Russia and Ukraine, which is still ongoing, and a few other conflicts besides. Silicon Valley Bank went bust nearly 3 years ago. I think next month, the UK government, kind of the bond market, pension funds all became quite an uncomfortable, a little bit of a financial vortex. And I think what you can see in the global economy is that all of these things had the potential to cause much more serious ripples, and they haven't. Strong balance sheets don't prevent problems, but I think what they do is what we've seen. What they do is prevent those problems becoming systemic. I don't think the world has a demand problem, but I do think it has a supply problem. Maybe on the supply side, let's start with governments, and I'm sure Cam will talk about some of this a little bit more. You know, Asia never gave up on industrial policy. It's always been a part of the policy architecture, but most advanced economies outside the region at least did give up on it for a long period of time. In the last 7 or 8 years, industrial policy is back. That means governments kind of are more focused on developing some domestic resilience, some domestic alternatives for things they might import, thinking more seriously about how their supply of certain products might fit with what happens if supply chains are again compromised. That's adding demand in certain sectors to the domestic sectors that are responsible for fulfilling those requirements. It's not great if you're a business that's competing with those sectors for resources, either labour or goods or technology. But obviously, if you're tapped into those supply chains, actually, it's a pretty good source of demand. The other shift in the global economy, of course, is global defence expenditure. You know, and if you look at the last couple of decades, I guess 20 years since 1995, maybe we could call it, you know, the Boy Scout period of global defence expenditure. A lot of economies, obviously, they all still have armed forces, but kind of not really, certainly not suitable for doing things on a serious scale. In many, certainly advanced economies over the last 20 years, for the first time in history, spending on healthcare has been higher than spending on defence. It's the first time that's ever been a common occurrence in the history of humankind, and the trends are pretty clear. I don't know what happens to the balance between those two things, but certainly it seems like at the moment defence spending is only going in one direction. Again, with implications for demands for resources. Germany, for instance, is actively debating reintroducing the ability for government to use conscription if they can't meet their defence recruitment targets. The German industry has said, well, if you need to pull the conscription lever, what does that mean about our ability to access the labour requirements that we need? Tariffs and demographics are another twin of supply side challenges, and I present Australia and New Zealand on this chart purposely. I think people in Japan and Korea, the demographic challenge is well known. China, for instance, demographic challenges of a scale that are unusual. Certainly I haven't been closely associated with. The reason I put Australia and New Zealand on here is because even economies with the great immigration superpower that both these economies have had are still facing sharply declining birth rates. If you want to ask me the role of house prices in that, I'm happy to talk about that. But tariffs, I think, mostly are a supply side problem. They mostly reallocate production and demand. They destroy some because prices go up. They're an extra cost in the system. And when prices go up, you do lose some demand. But mostly what happens, I think, is redirection. And that chart shows pretty clearly what's happened to the US since 2018 when Trump introduced a round of tariffs on China. US imports from China are down 20% from that period. US imports from every other destination are up 50%. You know, unless the tariffed economy happens to make something very particular for which there are no other alternatives, tariffs tend to redirect rather than destroy demand. Asia, of course, really in the epicenter of this, because a number of participants on this call will be from economies where part of the reason that you do have this incredibly robust, cutting edge, globally recognized export sector is because domestic demand is constrained. You know, often for demographic reasons, if not, there are other reasons. And so there's a reason why Taiwan might have a 10% of GDP current account surplus, and China's current account surplus has been growing quite substantially over the last 12 months. So far in this kind of tariff period, exports from Asia have held up pretty well. The purchasing manager index data, though, is suggesting there's going to be some payback into the end of the year, and that's what we expect. So certainly for Asian growth and asset markets, we think the rest of this year is going to be weaker, but not to the point that people worry too much about global recession. I mentioned China was a bit different in a balance sheet context, and it is quite different. It's really the only major economy that has a significant kind of non-government debt issue to work through in a range of sectors, and I think that is contributing to the structural slowdown. But I just want to talk about the export sector in China for a minute. In fact, the kind of produce to export sector, because we can argue if we like about Chinese capacity and whether it's excess or not. What we can agree is China's share of production in its economy is globally very high. China's share of exports in the world is globally very high. In fact, its share of production is so large now it produces as much as the next 10 largest production economies combined. And clearly some of those economies are finding that they don't want to give up any more market share to China. And this is part of the US tariff story, but also, you know, Germany's auto sector, for instance, bringing in some measures against Chinese EVs as another example of where we're seeing kind of this pushback by other economies against ceding more market share to China. So that, I think that's a shift in the environment for China. It's really had 20 years of amazing access to global markets, and that's being gradually pared back. The right-hand chart makes a different point, kind of China's internal challenge. If China is this great production machine that is super efficient, the puzzle is where the profits are. I mean, we can talk about the US and we can worry about the market value of Apple or Nvidia or some of these other great companies, but we can't argue against the reality of the profits they make. They're substantial. We can argue what PE we should be paying for them, but throwing off large amounts of cash, very unencumbered balance sheets, really unarguable. But yeah, when we look at China, there just don't seem to be these hyper profitable national champions. China's started talking about involuted competition, this kind of dog eat dog, lowest common denominator type competition. It does just look like there are habits in the Chinese system that encourage too much production. And so you get this great production machine in the left-hand chart, but actually the profits aren't really there. And that is an issue for China to resolve, because manufacturing is great for economies because it does three things. It employs people, it generates profits for owners and it pays taxes. So all the segments of the economy, if you like, get some spin-off. But if these Chinese sectors that are making all this production and employing some people, and that's good, if they're not making large profits and paying large taxes, then actually the benefit to the system is much more diminished, and I think is one of these issues which is just contributing to this structural Chinese slowdown over time. Let me close with one comment quickly on the US. Look, the US does seem likely, if you want to identify a problem on the financial side, there's two reasons why you might be focused on the US, and I don't think we'll see something acute. I mean, certainly I hope we won't see something acute, but certainly these are stresses in the system. US twin deficits are back to GFC type levels. I mean, other things probably have to go wrong, which brings us to the right-hand chart. It's just an interesting chart of long-term data on the annual number of physical interactions between the president of the day and the chairman of the Fed of the time. It goes back 100 years. This is a lot of presidential diaries, I presume someone went through to get this data. We know what happened to US inflation in the 1970s, and I just present this chart when you consider that unusually Donald Trump met the chairman of the Federal Reserve the other week. I'll stop sharing there. Thank you very much.
Rowena Smith, CEO of Australian Strategic Materials. We'll move it on over to you. Thanks, Rowena.
Hi, everybody. I am Rowena. I'm the CEO for ASM, and we're going to give you a bit of a case study of a business that is getting up and going in all of this geopolitical uncertainty. We are building a global rare earths and critical minerals business. And, one of the things specifically about rare earths is that over 90% of that supply chain currently exists in China. So the world has really, in the last 20 years, become very dependent on that single source for these materials. And these materials are an essential part of a lot of the advanced technologies that are developing, the EVs, the wind turbines, a lot of those clean technologies, but also robotics, and a lot of the defense applications. And, so that vulnerability in that supply chain is significant. And the geopolitical uncertainty that is there at the moment, certainly for rare earths, we see that as really driving opportunity for us. It's not providing certainty, but it is providing opportunity. With the tariffs in particular that came in recently, even though the vulnerability of this supply chain has been well understood for a long period of time, it wasn't felt. I think that there was just a complacency in the system of relying on low-cost material coming from China. And it's really just been in recent months with the tariffs, first of all, being imposed, and then China's response to that was to restrict export of these materials, not just to the US, but globally. And in particular, they've restricted the heavy rare earths that are an essential part of the alloys for these high-performance magnets that are needed in all of these various different applications. What we've seen is then a significant step up in the Western governments of prioritising with urgency the establishment of alternative supply chains. That's really feeds very well into what we're doing here with ASM. We've been working on this for a long period of time, anticipating that this alternative market would be given priority. We thought it would happen sooner, but it's certainly, we're ready now as the world is giving it priority. We've got a mine that we are developing in New South Wales in Australia, where we will mine, separate and refine these materials. And then we will take it all the way through to metals in one of our metals plants, the first of which we've already got built and it's in production in AustCham in Korea. And we're currently advancing our plans to replicate that facility into the US in order to be able to provide this mine all the way through to metal supply chain for the magnet producers that are emerging in a number of these Western jurisdictions. to be able to support all of these various different manufacturing technologies. This is our Korean facility. They're in the foreign investment zone in AustCham. We're very proud of this facility. We built it through COVID, and we have been producing here for customers since 2022, the light rare earth metals, and then more recently also the heavy rare earth metals, but importantly also those specialist alloys that are done to customer specification for the magnet production. The reason that an Australian company chose to build their first metals facility in Korea, I think is important to just dwell on for a moment, because obviously we made that decision back in 21. It was just post-COVID. Or in fact, we were still well within COVID restrictions at that point. The reason for Korea is that Korea was actually one of the early countries to start to move policy to support the building of these alternative supply chains. Japan was the first. Japan experienced a disruption in this supply chain back in 2011, and so they actively worked on developing some alternative materials to be able to come into their supply chain. But Korea was the other country that wasn't as advanced as Japan, but certainly started to put policy in place. And some of the policy that they put in place particularly was support around R&D funding for research for technology development in the metallisation of these rare earths. We saw Korea as being a community that had very high technical expertise, very strong manufacturing competencies. We started working with the universities and through that supportive funding about 10 years ago now, so well before we built this facility. But we also saw it as where there was a natural synergy with the Australian, competency, which we're resource rich. We've got very rich endowment of the raw materials. We've got very strong mining and mineral processing competency, but we don't have the same strength as Korea does in the manufacturing competencies, and we don't have those strong end markets with the OEMs that are actually going to be using these materials. And we thought that it was important to be placing this metallisation facility co-located with the magnet manufacturers, but also co-located with those strong end markets. So that's why we chose to do it in Korea when we did. We've spent about $60 million US there to date in that facility, and we've currently installed capacity for about 1,300 tonne per annum of that specialist alloy. But the design capacity is 3 times that, and we will ramp that up as the market ramps up. We, very much stepped into this piece of the supply chain ahead of the rest of the ecosystem. And that has been challenging for us. So as I talk to what the challenges are for a business, really trying to establish this alternative supply chain to meet these supply challenges, the first is that, we have got this plant there, but the magnet producers in the Western world have been a lot slower in establishing themselves. We have seen movement on that in the last 2 years, and in particular, we've seen significant movement for them in the last 6 months, but it certainly has been slower than we anticipated. We've also been working here in Korea while we've been, working with those emerging producers. We've been working on broadening our product range, and we have just recently sold our first heavy rare earth metals from this facility, which is a very, very unique capability outside of China. But I think for anybody who's wanting to step into this supply chain, one of the challenges is you've got to develop all of this technology and technical expertise. You've got to be able to do it whilst the rest of the ecosystem is also in the same development phase. So what we've seen since those restrictions have come in place with particularly the heavy rare earths no longer being exported from China, we just saw an urgency around the OEMs in various different jurisdictions all wanting to source non-China magnets from non-China materials. They wanted to know that they actually had an alternative supply for continuity. And their price sensitivity, which had been very strong up until that point, the pricing that was coming out of China was very low. It was very attractive to stay on it. Nobody wanted to be the first mover to move away from it. That sensitivity is gone now as they're facing the cost of not having raw materials. Ford, for example, within days of the restrictions coming in from China, announced that they were going to have to close one of their production lines for their EV manufacturer. So, it's a very immediate commercial impact when that supply chain is disrupted. So we are working with the emerging magnet producers across multiple jurisdictions, both domestically, but also exporting from our Korean facility into the States, into Novion Magnetics, which is an emerging producer in Texas, Vacuum Schmelz, German, who also have US funding to replicate their magnet capability in the States, as well as USA Rare Earths and NEO. NEO are actually opening their new magnet facility in Estonia next month. So a lot of emerging capability here, but it's all still very early. And that's on one side of the metals facility, but on the other, obviously, is where are we getting our supply from? So we're working, again, with some established but also emerging producers in Australia, in the US and in Europe. But ultimately, this whole chain is dependent on being able to source materials from the ground. And whilst there are some that are developing the light rare earths, there are very few that have source material of the heavy rare earths that we're going to need to be able to make these specialist alloys. And that is an immediate issue for this supply chain. So I think that lastly just takes us to the other large project that we've got, which is the development of the mine and those raw materials from Australia. We've got a very special ore body there in Australia that has light rare earths as well as a large endowment of these heavy rare earths, which is, definitely an advantage for us because that's quite unique. It also has three other critical minerals, zirconia, niobium, and hafnia, which are also on the critical minerals lists in a lot of these Western countries. And I guess what I would say is one of the challenges for this industry is that on average, it takes 18 years to develop one of these ore bodies all the way through the development phases into production. We've been working on our project here in Dubbo now for 20 years. So we're very advanced with this project, but even still, we would still, if everything went absolutely perfectly from today, first production from this facility would be in 29. So these are long-term investments, and one of the frustrations I know in recent weeks when the supply chain started to respond and urgently want to source these materials, they all want them to be available immediately. But if you haven't been doing the investment over the last 10 years, then you are going to see a delay before you're really going to see volumes in this alternative supply chain. The Dubbo project is a long life ore body. We've got, 75 million tonne of resource there. So it's a multi-generational project. In a tier 1 jurisdiction, it's fully approved. We've done 20 years worth of development of the technology, so that's all developed and proven. We've been working with Bechtel Engineering. So even though we have got through all of those challenges that a lot of our peers are still working their way through that as they try to progress their projects, the real challenge for us in recent times has been this is very capital intensive, and we're looking at about $1.3 billion US to be able to build this facility and bring it online. And that is significant when we are a small market cap listed on the Australian Stock Exchange. And indeed, most of the rare earth deposits are owned by what we would call juniors that have got modest market caps. and certainly low compared to the capital intensity of these developments. And so one of the things we've been challenging ourselves is there a lower capital pathway? What we have done recently is looked at, instead of bringing all of the critical minerals that are in this ore body into production at the same time, could we look at just doing the rare earths where there is this urgency? And ideally, what we will see is that the end users will start to use their balance sheets to be able to help fund these projects. But nonetheless, you do want them to be, lower capital hurdles to invite that investment. So we've been able to, with innovation money, which again, we've been getting support, where Korea 5 years ago was one of the few governments that was providing R&D support for this sector. Other jurisdictions have caught up, and Australia certainly in recent years has been very supportive in this space. So we've been able to get funding support to be able to do some of the innovation work that we've now got a pathway that is much lower capital, less than 500 million US now, for us to be able to get the rare earths into production. And we've got a flow sheet also that is first quartile cost, which is really important, that as we build these alternative supply chains, that they are going to be sustainable in their own economics and not need government subsidy in the long term. Funding it, even though it's been challenging, we've actually had a lot of support internationally from the ECAs, from governments helping to do the debt funding part of that. You can see there we've had over $1.5 billion Australian conditional support from the ECAs, which is fantastic. But what governments have realised recently is that it's not enough to just provide some cheaper debt funding. There needs to be more price certainty, and these markets are opaque. They are vulnerable to manipulation, and they're certainly vulnerable to disruption. So what we're seeing more recently, the US have just made a very material announcement of an investment in a US rare earths business, MP Materials, where they have provided equity. They have that's a significant development for the US government to invest directly into a private company. They have they've done national offtakes, and they have put a price floor in that is almost double what the current China pricing is. So that's a significant disruption, which is welcomed. We know that governments elsewhere, the Australian government, the Korean government, as well as the European governments, they've been developing these sovereign funds, but they're also looking at, well, do they need to do similar interventions? And what is the way to really provide fair pricing to ensure that this alternate supply chain does attract private investment? So I think one of the things that's become clear is that, you can't do this in one jurisdiction alone. If we're going to rapidly get all parts of this supply chain up, simultaneously, if we're going to attract private investment, if we're going to be able to ensure that these materials are available to be able to support the manufacturing industries in these jurisdictions, and the economic security, then we need to work collaboratively across allied partnerships. And I know that there's a significant amount of work going on at the moment with Australia, with Korea, with the US, with Japan, and with Europe in particular, to look at policy alignment and to make sure that there's a suite of incentives, which may also include domestic content requirements. And obviously, tariffs can be helpful if used appropriately to support this, but also just understanding how we play to strength. So where there's a natural synergy, as I believe there is between Australia and Korea, Korea and the US, with Australia as that source material, then how do we make sure that we've got policy that really is facilitating that? How do we make sure that we remain cost competitive is another key component. And I think particularly the cost of power and the cost of labour is really challenging for a number of these jurisdictions. So that we've got to really turn our mind to. And I think the thing that most recently I would comment on is that this has moved very slowly in the last 5 years. It's now moving very rapidly. And the US are definitely setting the pace at the moment, and other jurisdictions are trying to speed up. But the risk is that things are going to happen much faster than, Australia and Korea are ready for. So that's just a bit of an overview of someone living the dream in this time of opportunity for rare earths.
Thank you very much, Rowena. That was fascinating and very exciting as well.
Superb. That's a relief. Look, it's great to be able to wrap up this session. I think we've picked up some really useful themes from both Richard and Rowena, and thankfully my update's going to cover off on a few of those recurring themes, things like industrial policy, defence, global manufacturing, and of course this critical and rare earth minerals sort of aspect to geopolitics. So I'll endeavour to tie all of that up. One thing I might do before I start into my session is just maybe remind everybody exactly where we've come from over the last 3 months or so. It's been an incredibly busy geopolitical period since May. And in terms of what I try and bring to these updates, a lot of it's really informed by the timing of the update. So if you think back to May, we actually had a pretty important escalation between India and Pakistan. I don't like to use the word unprecedented, but of course we did have extended use of drones between the two sides, combat aircraft being shot down and so on. And that became quite a key focus for us. But just the noise of the landscape, we moved from May into June. Then, of course, we saw this London agreement between the US and China, where we started to see the contours of potentially some sort of an agreement on not taking extreme courses of action against each other within a relationship, which of course is categorized as overall one of competition and contest. Just as we tried to get our head around that US-China dynamic and development, of course, we then moved into the 12th of June with a 12-day conflict in the Middle East, potentially very significant in terms of the implications for energy markets and for stability in the region. Thankfully, of course, that conflict ran its course without a significant escalation. And then the day after the conflict ended, on the 5th of June, Donald Trump went to NATO and again, potentially surprised many of us with a quite different focus of engagement with NATO, getting those defence spending agreements up from 3.5% to 5%. We can talk about, the viability of those commitments if you'd like, in the Q&A. But it did show you a quite significant pivot from the US in terms of its Russia-Ukraine policy up until that point. And then, of course, towards the end of the month, we then moved into tariff period. So for the last 4 weeks, I've got no doubt most of the people on the call have been trying to work out what the implications of these various framework agreements are going to be. And then at the very end of the month, we had quite surprising, I think, for many people, border dispute between Thailand and Cambodia. So it's just a good example of the amount of noise and the amount of geopolitical churn that we're dealing with at the moment. That's a potential sort of half decade's worth of developments in 3 months. For the session itself, I'm actually not going to be focused on those things in too much detail. I'm going to look really through the lens of the White House and how the Trump administration is considering some of the issues that really do matter to, I would argue, your members. So particularly in China, Hong Kong, Japan, and South Korea. I only have a couple of slides. So the first of those is, you'll find this quite familiar, similar to Richard's slide. I do think it's an important one to remind everyone of. It's this world shares of gross production conundrum, if you like, for the United States. That red line of China now being at almost 40% of global manufacturing. and the US corresponding yellow line really dropping now into the mid-teens. That's of significant concern to the United States. Of course, reindustrialization is a core commitment for the Trump administration, but I think it's important to remind everyone that he's not looking at replicating China. He's not looking for a reindustrialization across the board. There is very much an economic security lens that's being applied to this reindustrialization approach. So we should expect to see reindustrialization in that steel sector, in the energy sector, in emerging technologies and defense, shipbuilding, the sorts of things that you really need some sort of baseline capacity in if you are to feel economically secure. I think the other point here is that that's worth flagging is that this focus on reindustrialization is also it's bipartisan. The big distinction between, I think, the Trump and Biden administration's approach to addressing this reindustrialization conundrum is one of funding. So, of course, the Biden administration was leaning heavily into government support. The Trump administration is taking a different approach, and it's focused very much on encouraging, coercing, whatever word you'd like to use, more private sector investment from not only the United States, but from other countries as well to help with that reindustrialization process. I think the other aspect here that's also worth thinking about is the Trump administration hasn't completely dismissed the concept of industrial policy. There will still be government support in key sectors. And as Rowena mentioned in her session, I think critical and rare earth minerals is a really good example, I think, where this government, the current Trump administration, feels that while they're loath to offer up government support across the board, there are going to be some key sectors where that will be required. And that NP materials example that Rowena flagged is a really good one. I think that's the sort of thing we should expect to see more of. So that's why Trump's focused on reindustrialization. Why is Trump focused on tariffs? Now, I think this is also an important thing to have in the back of your mind. The reason I've put a reindustrialization and a tariff slide up front is because I think hopefully it sort of reminds people that these focuses on reindustrialization and tariffs are really going to be quite long lasting. I don't think these are idiosyncratic approaches. I think this really runs to the core of the Trump administration's approach to economic and diplomatic statecraft. Trump's Liberation Day speech on the 2nd of April, of course, the one that triggered some movements in the bond market, there was a small one-liner in there that I think was quite instructive, really talking about, broadly speaking, Trump's distaste for income tax and the idea that why should Americans be paying taxes when there is an opportunity to tax foreigners via tariffs. So I think this tariff approach is really going to be here to stay. As you can see from the chart on the right, customs revenue as a share of total US federal revenue, I'm not suggesting we're going back to the 1850s, but you can see that flat line really ever since the Income Tax Act of 1913 is set to go up. We're now looking at around 14%. There's potentially going to be a fairly long-lasting series of at least efforts to maintain tariff receipts as a form of alternate revenue. What's the sort of mantra, or what's the sort of broad thinking for the Trump administration behind these developments? I think in a nutshell, there's a sense that America spends too much and it produces too little. Equally, there's a sense that China produces too much and spends too little. So there's going to be an effort to reorient this. And then for this particular slide, I think there's a mantra that the international financial and trading system is no longer fair for the United States. Now, we can obviously debate that point, but I think that is a theme or a perspective that's going to be pretty hard to budge from within the Trump administration over the next 3 years or so. In terms of tariff receipts, of course, the Trump administration sees this as a revenue-raising tool. I don't think they see it as a silver bullet to address the US deficit, but it is potentially a revenue stream that they're going to start to rely on a little bit more than they have in the past. We're looking at figures of between 300 to 500 billion. I'd say the 500 is more optimistic from some Republican quarters. Scott Bessent himself has talked about 300. Again, I go back to which of these policies are bipartisan and which of them are not. Reindustrialization, as I mentioned, is bipartisan. I would argue that tariff revenues, perhaps not the approach that has been taken to tariffs, but the way in which tariffs will present a new revenue stream for the United States potentially is also something that is bipartisan. So perhaps not a focus on tariffing allies and partners in quite the same fashion, but the idea of bringing in a revenue stream, I think, will be something that both sides of US politics will find hard to walk away from. And there's also just a confidence in the United States around tariffs. This broad view that the US is the biggest consuming economy on the planet, and that allies, partners, adversaries alike are just going to have to eat a certain amount of tariffs. And I think we've very much seen that play out through the negotiation processes between the US and its trade partners over the last few months. And I will now go to my final slide, which is really what are the impacts of all of these various trade policies. And this is really bringing it back to the audience that we have today. Look, I think we've seen the end of really phase one of the Trump sort of tariff focus, which of course has been on reciprocal tariffs. Most of those have now settled. We can debate this in the Q&A, but I'm seeing a fairly broad sort of breakdown of reciprocal tariffs into 3 tiers. You sort of got a 10%, tariff rate for countries that either of limited consequence from a trade perspective for the US or that are running a deficit with the United States. You've got a 15% tariff rate, which has really been settled on for some of those big trading partners. Of course, this is not going to be unfamiliar to the Koreans and Japanese in the audience. That's that 15% rate. The European Union likewise. And then we've sort of got a 20% plus rate for some of the other trading partners that might be sort of sitting in the more adversarial bucket as far as the US sees it. There are higher rates, of course. There are a few exceptions to the rule, but I think all of those potentially end up getting negotiated in some way in the coming months. I'm not really here to focus too much on the reciprocal tariffs because I think the thing that's going to be important over the next couple of quarters is how the Trump administration starts to focus on sectoral tariffs and also what's being referred to as secondary tariffs. So this is the idea of using tariffs in the way that you would potentially use sanctions against trade partners that are embarking on diplomatic courses of action that the United States might not think is in its best interests. We've obviously seen this most recently with India, this secondary tariff rate that's going to kick in at the end of August, which is connected to India's continued purchasing of Russian oil. I'm not sure if that's a blueprint that the Trump administration will use in future, but it's definitely something we're watching. And then the sectoral tariffs, of course, are the ones that are going to be important to watch. Whether or not Trump starts to roll those sectoral tariffs into the broader framework trade agreements that have been struck, whether or not they sit separately. Pharmaceuticals in particular is one that we feel that will be quite difficult, I think, to roll into a flat tariff rate. We've already seen agreements on the semiconductor space where carve-outs can be made. So if I had to sort of put a broad takeaway down for this tariff environment, I think we'd all hoped for a little bit more predictability after the 1st of August, and I would agree that the tariff landscape is less unpredictable, but it is still unpredictable. We need to remember that the framework trade agreements have been struck through the executive branch of the US government. That means there's no trade promotion authority sign-off through Congress, which means Trump has the capacity to reconsider these deals at his leisure. I'm not suggesting that's guaranteed to occur, but you can imagine if trade dynamics with particular trade partners are not going as well as they might like them to be, there's potentially an opportunity there for Trump to start to open up and modify some of these framework deals. So I think that's something we should be mindful of. Finally, these are going to be very messy. We're going to see pauses, carve-outs. The 90-day extension for the China tariffs is a good example while negotiations continue. And then I really don't think there's a silver bullet solution if you're hoping that tariffs will magically vanish because the US judiciary will find, against the Trump administration, while the tools that the Trump administration is using to roll out the tariffs, the universal tariffs obviously are being rolled out through IEEPA, an Emergency Powers Act. Trump still has tariff measures within the toolkit that are legal through the Trade Promotion Act. So Section 232, 301, 338 and 122 are all available to him to roll out what would broadly be, I think, a similar tariff arrangement than we have today. Now, just to finish up, if we bring it back down to this part of the world, I've talked through some of the US framework trade agreements in terms of those tariff percentages. But of course, the other slightly novel approach to these framework trade agreements is the investment pledges that are coming. 350 billion from Korea, 550 billion from Japan. Now, we'll know more about that, I think, from the Korean standpoint after President Lee meets President Trump in Washington on the 25th of August. That will give us a bit of a sense as to which sectors are going to see some of this investment. I don't think anyone who's followed this closely is of the view that that $350 billion will be dollars spent in an efficient process. A lot of this investment pledge is through the form of loans and guarantees. But I do think it is going to make some sort of adjustment positively from the US standpoint to that reindustrialization focus that they have. An interesting little insight here is that $150 billion worth of that investment pledge is geared towards the shipbuilding sector. So if you remember in my opening remarks, there is an economic security lens, I think, being applied over tariff policy. Shipbuilding and the Korean shipbuilders' capacity to help the United States lift up what is an incredibly moribund sector, I think is a good example here. No silver bullets, but all gradual improvements, I would argue, to some pretty perennial challenges for the US. There's also a security element to these framework trade agreements. If you think about Korea, Japan, and the European Union in particular, now, perhaps if you're an industrialist in Europe or Japan, you're not particularly happy with a 15% flat tariff rate. But if you are a bureaucrat or you're Ursula von der Leyen, for example, in Europe, you're quite happy with a 15% tariff rate because, of course, for you, it's not just about the tariff, it's about the broader relationship. And I do think there is an element of security connectivity here between the US and its trade partners that I've just listed that sort of underpins or at least undergirds some of the discussions and some of the agreements that have been negotiated to date. That's the framework trade agreement aspect of US dynamics with those partners. There's also a diversification aspect, of course. We're going to see more free trade oriented countries trading more closely with each other. We've already heard from Rowena that there's going to be more Australia-Korea engagement in the critical rare earth space. There's probably going to be a similar arrangement with Japan that's already fairly well established. And we've just seen news in the last 2 days that South Korea has struck a $150 billion deal to boost investments and trade with Vietnam. Again, sort of two countries leaning more towards the free trade side of the equation, and there is a defense element to that. Finally, on US-China, it would be remiss of me not to talk about the US-China relationship, and this is my last sort of point before we open to Q&A. I think there's obviously a broadly structural dynamic between the US and China that is skewed towards competition. That is unlikely to change, so I'm not going to sugarcoat that. But I do think there has been some very positive dynamics in terms of the cyclical relationship between Washington and Beijing over the last few months. Most, I think, what's the word? Sort of greatest relief, really, was the, I think, realization in Beijing and Washington that marching towards some sort of mutually assured economic destruction through 145% tariff rates was not in either country's best interests, and there was an agreement to try and, or at least there was an agreement on both sides to try and find some sort of pathway to stabilize that trade relationship. Likewise, very intriguingly, things that have come out of that London framework agreement, of course, hinge around the supply of semiconductors to China on the one hand, and the Chinese supply of critical minerals or rare earths to the United States on the other. The levels of distrust between the two sides are obviously very high. So I'm not suggesting that we feel that there's likely to be any kind of grand bargain between the US and China when Trump, if and when Trump and Xi Jinping do meet in Q4 of this year. But there is likely to be some sort of an agreement on an appropriate supply of, US security hawk tolerated levels of semiconductor capability in exchange for potentially a more stable supply of critical minerals from China until such time as the US, as was mentioned by the previous speaker, works more collectively with its allies and partners and tries to build up some sort of parallel critical and rare earth minerals supply chain. And I think that's me just on time or just short on time. So I will stop there and open to Q&A. Thank you. Thank you.
Thank you very much, Cameron, and all the speakers. It was really fascinating. I think we could obviously go over this hour, but we are running out of time now, and thought we should have a short Q&A session. Look, we do have a number of questions, but look, I think we'll just take one question each. We have a number of questions. Can I first turn to Richard? There's a question from one of the attendees, and the question is, are there any sectors or asset classes you believe are underappreciated in the current environment?
It sounds like a personal advice kind of question, so I won't read the whole disclaimer, but this is general advice, not personal advice. The answer is easy: non-US dollar fixed income.
Thanks for that. And perfect given the timing right now. Cameron, I will go back to you, and I had a number of questions myself, but there was one question from the audience. If the tariff revenues are a tax on US consumers and they will be inflationary, how long will consumers or voters tolerate this once they actually understand that they've been conned and it's not the exporting country paying the tariff?
So great question, but I'd argue also a question with an assumption in there. So pretty early for us, and I will definitely give Richard an opportunity to weigh in on this. Obviously, there is a risk that these tariffs are going to be inflationary. I think that is a big focus for Scott Bessent in the Treasury, monitoring what the sort of impacts of these tariff receipts are going to have, not only on addressing or at least potentially helping to alleviate the deficit. The risk, of course, is what it does to the US consumer and that inflation point. It's too early, I would argue, to say what's going to happen, but it is definitely an area of focus for the administration. Whether or not the consumer carries all of the costs, or whether they're borne across the consumer, the distributor, and the source of the product, I think is that is a question that economists will be able to write PhDs on for many years. But I'll hand over to Richard. I'm not sure if you've got any other sort of views on this one.
Well, two quick things I would say. One is, even if businesses absorb the costs in the short term, unless the shareholders of that business or the owners want permanently lower returns, they're going to get passed on eventually. And that's why economists say consumers always pay. There's a timing question, but probably not an endpoint question. The second thing I would say is, well, it's all a bit murky, isn't it? If you start to replace the head of the statistical agency, and the central bank perhaps is not as technocratically independent as it used to be, it all gets a bit murky about what will be seen in full transparency and what might be kind of hidden a little bit more.
Thank you very much, both. Rowena, finally, I'd like to ask one question. And it's fascinating listening about the timing as to the various productions that you have. But in light of that, I mean, for example, when things need to be done very quickly, how important is transparency and traceability in your supply chains, especially dealing with international buyers and navigating the various regulatory environments?
So I think, the whole premise of this alternative supply chain is that it is sourced via non-China materials. That's what they want to see, and that there's more emphasis on security of supply than there is necessarily on the ethical supply. So I think maybe 5 years ago when we were talking about tracking transparency and, whether it's through blockchain or, various different passport sort of processes, people were more concerned around the ESG performance. Whereas now it's very much they want to know that they have got security of supply. I think when you're talking with critical minerals, you're generally talking about much lower volumes. These are not like the iron ore. They're not big commodity products. They are small volume and they get made into boutique alloys. So actually, I think what we'll see is that the transparency will be effectively provided through relationship building. People will work in partnership across that supply chain, and then they will be confident around their source materials.
Thank you. That's well understood. We have gone a few minutes over time, so again, I'd really want to thank, on behalf of AustCham and for everyone attending, we'd like to thank guest speakers today for your time, insights, and engagements. Really could have gone for another hour or so and had many more questions, but thank you very much. A final thank you as well to our event partners, ANZ and Australian Strategic Materials. Your continued collaboration with the chambers makes events like this possible, so thank you again. And of course, a thank you to our fellow regional chambers, AustCham China, AustCham Hong Kong, and AustCham in Japan. A thank you to standing with AustCham Korea to strengthen Australia's business connections across Asia. Finally, we hope today's discussions have given you useful insights into the challenges and opportunities ahead. And we look forward to hosting similar events in the future. So thank you very much. Have a great day, everyone, and over to you, Rowan.
Yeah, thank you very much, everyone. If you have any further questions for our panelists or for the chamber, please feel free to get in contact with us at AustCham Korea. Once again, thank you very much, everyone, and look forward to speaking to you again soon. Thank you.